Hello everyone. Today I'm going to talk about AMD stock valuation. AMD is one of the top semiconductor company, and this is the first company I valued in 2022. In this video, I just shows the value per share that I estimate AMD in 2022, and I sent to my friends. You can see my prediction during that time. You can tell that I estimate the value at around 104 to 108 in 2022. This picture just shows the price history for AMD. You can see that after my valuation, the stock has slammed to as low as 85 and also goes up to as high as 200 and goes back to 100. In this video, I will explain AMD business model and segment and AMD revenue forecast, analyst channel risk, and stock value and price estimation. Business model is how the business generates revenue, make profit, and reinvestment. If you want to understand the stock, you need to understand its business model. Next, I will estimate the AMD revenue and profit in the future. Another hot topic in the past year is the Trump tariff towards the world. So in this valuation, I will also explain how do you analyze and quantify the tariff effects, not only on AMD, but also on all stocks. And the next is the stock value and the price estimation. The value and the price are two different things. How much value was seen is about how much free cash flow the company can generate in the future. For example, if you are a investor and you want to buy a football team, you will want to know how much revenue, how much ticket it can sell in the future, how much profit they can make in the future, how much you need to pay for the players. But for the price, it's like you want to buy a second-handed football ticket from other people. The price depends on demand and the supply in the short period. The price can be much higher or lower than the price on the official website. Just think about if you want to buy the Taylor Swift foot ticket, probably they sell around two or $300. I don't watch, so I don't know. But if you buy from other people, if many people want it, a $200 ticket can go as high as $1,000. But that will not affect the value of the music group or music team who have a contract with Taylor Swift in the long run. In contrast, if people just learn that there will be have a heavy rain on the concert, the second-hand ticket price will slump. So that's the difference between value and the price. But first, I will explain the business model, what the company is doing. AMD mainly designs semiconductors, CPU. Many people should have known CPU if they have used computers, but I will explain a little bit more here. CPU is working like our brain. If you get the smell of cake, you probably want to eat it or get hungry. But what really happens is your nose gets the sensational information from the smell, and they send information to your brain, and your brain tell you that you can eat it. For people who are in vegetative condition, they do not have any reaction to the outside stimulus because their brain doesn't work. CPU works the same way. When you type your name on the keyboard, the CPU gets the information, get the signal, and they transfer that information to your screen. That's how you see your name on the screen. But just like our people, we get busy, we get tired, and we may make mistakes if we want to multitasking. Computers get stuck if you give them too many tasks. That's when the GPU came into play. To understand GPU, I want to recall how you apply visas if you want to go other country. In the old time, people need to go to if they live in a small city, they need to go to the bigger city to go to the consulate of the country to apply visas. But in the recent years, especially European countries, they have outsourced those to the third party called VFS Global. In a city, they will have three or five VFS Global to deal with the visa application at the same time, rather than just count on one consulate. So that is how the GPU came into play. And here, this is information I got from the AMD annual financial report. This is so different business that AMD have right now. First, we have the data center. That's just the AI people talking about, and we have CPU, GPU, etc. The next is client segment, and the company have CPU. These two differences, like this CPU is for the AI need, and in contrast, this CPU just for desktop. For example, people like me, I just use laptop to use Excel to analyze stock and watch some video and then make this analysis for you guys. I don't need very advanced chips or semiconductors. The next is the gaming segment. When people want to play some fancy game, they need higher resolution and there are much more informations, and that's the gaming segment. The next is embedded segment. Embedded segment is usually for many what I call small devices. Just think about the remote you use for the AC. It does not require very high computing power, but it still need a brain to work for that. So that's the embedded segment. In this graph, I just show you different biggest segment, their market share, and their biggest competitor. In the data center, you can tell that the AMD have around 35% market share with Nvidia as the biggest competitor. That percentage may look kind of high. I will explain why is that later. The next, we have client, the CPU. The AMD has around 50% market share with Intel as the biggest competitor. We also have the gaming and embedded. In the gaming, Nvidia has a dominant position with AMD have 10%. And if you see this picture, that's in fact brings about a very important mindset in my valuation. In the past year, people always talk about AM boom, about how advanced NVIDIA is and how dominant NVIDIA in the chip sectors. I agree that NVIDIA has very much more advanced technology, but investment is not buying the best company. It is about buying the asset at undervalued price and sell it and at the overvalued price. So while NVIDIA is dominant in the GPU sector, I do believe that AMD has potential to take over Intel in the CPU sector. And next, I will talk about how to estimate the growth rate. Just think about you buying stock or make some investment. Like for example, you invest $10,000 and you make 2,000 gain. You have 20% return, right? But if you want to make more money in the future, for this 2,000 gain you have, you need to take at least take a portion of money to invest again to make more money in the future. So this is what I call the reinvestment rate. Reinvestment rate just how much money the company make that will put it back to invest for future project to make money. And another thing is called the return on capital. Return on capital just like that 20%, how much money you make. Like for example, if the company spend 10 billion to design new chips, they generated 2 billion profit, the return rate will be 20%. So these two are what I call the driver for the company growth. But many people will see that they don't know where to find information about value stocks. So I will explain and tell you how to find that. So first here we have the capital, CapEx. CapEx is called capital expenditure. They are mainly the fixed asset. For example, if you are a manufacturer, you need to pay money for the factory. And for the company like Nvidia or AMD or other technology, they probably need to spend money on some equipment. That's called CapEx. But what is good is that when you have some assets, when you have some capital expenditure, you can claim a depreciation to reduce your tax. For example, if you have equipment for 10 million and the equipment has estimated 10 years life, you can record 10 divided by 10, 1 million depreciation a year. That will reduce your tax. The next is the NOWC, net change of working capital. That's just the capital you need for daily to daily business operation. Just think if you have a convenience store, first you need to have some cash on your balance so that you can use that for change or buy product. Another thing is if you have convenience store, the product like those chips sodas on the shelf will be more than how many people usually buy in a certain period. Otherwise, you will have stock out. This is the OWC. The next is R&D expense. This is one of the most important investment for technology or semiconductor company. That's the research and development expense. But how accountant record it will mess up the company performance and the reinvestment. For accountant, they will record the R&D for the current year operation. But think about that. If you are AMD, if you spend $10 billion to design a chip for this year, you are not going to expect to make all of money from this chip this year, right? You at least will make money from that for next 3 to 5 years. So what I usually do is I will first add back the R&D reported by the accountant, and I estimate how long the investment can last. If the company spends 3 billion current year, for example, and I expect the investment can generate benefit for 3 years, I just use 3 billion divided by 3, I got 1 billion. So I will add back the R&D and subtract just 1 year, 1 billion for the current years. Another thing is acquisition. Acquisition means the company want to buy another company. And it's very important, especially because according to source like McKinsey and Harvard Business School, around 50 to 70% of acquisition end up losing money. So if the company acquire another company, you better take that into account because that can burn your company's cash. And after you get all of them, you divide it by the after-tax operating income. Here it's just called EBIT with the R&D adjustment. And many people have been asking me where to find those information. So in this video, I will just show you right now. This is the website where you want to find the information. This is the US Security and Exchange Commission. Here you have the company search. You will type the company ticker you want to learn about. We have AMD here, and you click. Here you will have the 10Q and 10K. 10Q is a quarterly report. It's usually released every 3 months. And here we also have the annual report. Is 10K is for the 1 year. And you scroll down, you will always see there's something called a financial statement, and you click that. There are three major financial statements. One is income statement, also called statement of operation. This just show you how much the company earned for the current year. Like here you have revenue, and you can see this the operating income. That's the EBIT I'm talking about. And if you want to know the capital expenditure I'm talking about, you will check the statement of cash flow. In the statement of cash flow, they usually have operating activity. That's for the operating, just like the name suggests, and investing activity. That's for the investment. And the financing activity is for the borrowing money. And if you want to check the funds capital expenditure, it's usually in the investing activities. It's either called capital expenditure or like property and equipment. So here, as you can see, we have around 600 million. This is the capital expenditure. And for the depreciation, you will find in the operating activity, we have the depreciation and amortization. Next, we'll talk about the net change of working capital, the capital the company need to maintain for the day-to-day business. That is in the balance sheet. In the balance sheet, you have the current asset and the current liability. They call it current, that means within 1 year. You use the current asset, subtract the current liability, you get net change of working capital. But there's something you need to be careful. The net change of capital, like I said, is the capital you need for day-to-day business. And if you want to know that, you need to subtract the cash because the cash just stay here. They're not used for investing the project. This company has 3,000 millions on the balance sheet, and if they want to invest some new chips, they're not going to be spend this money, right? That's just on the balance. You need to subtract this one. Another thing is short-term investment. Short-term investment, sometimes called marketable security. Security that company buy, they probably buy some government bond or corporate bond to generate some return from their cash. Just like what, like for example, if you are running a convenience store and you also buy some stocks. And right now you want to know how much return you have from your convenience store. You don't want to add your stock investment to your convenience store, right? So you need to subtract this too. And for the current liability, they will have the current portion of long-term debt, all called short-term debt. That's just the money the company borrow within a year. And because right now we are calculating the reinvestment and investment capital, we don't want to mingle the debt in it. If you can see, the company has 700 debt in 2023, but they don't have that debt right now. Say if you value the company in 2023 and you add 750 in it, and when you forecast in the future, you will assume that the company will borrow this amount of debt every year. So you will subtract that from the current liability. And if you want to think about debt, after you estimate all the company, you see how much debt they have right now, and you subtract that. This is how you get the NOWC. Sometimes the company will have acquisition. If you see here, it's also in the investing. You can see that AMD acquired some company in 2022. So here you have the acquisition cost. And when there's no acquisition, you just didn't see anything. So by doing so, you just can get the information about the reinvestment rate, and you just calculate that. And after you know the reinvestment rate, you also know the return on capital. Return on capital here, you see the formula, the fixed asset. That if you want to calculate the net change of working capital, you have current asset and current liability. That's just a short-term asset. But here you have total asset for this item. These are just long-term asset you need to invest. So that's the fixed asset you need to consider when you estimate the reinvestment rate. But just be careful. Here, it have goodwill acquisition. What is that? If the company acquire another company for 10 million, but accountant only can justify 5 million, they don't know how to justify another 5 million. They just made up something called goodwill. And so when you consider the total investment, you shouldn't care about this too. You just add how much money the company really spent. Like for example, if the company spent 2 billion to buy a company, they paid 2 billion to buy a company, and the accountant said the 2 billion consists of 1 billion asset and 1 billion goodwill. You don't need to care about the goodwill, right? You just add the 2 billion in it. So this is what you got long-term asset, fixed asset. And after you get those information, you have the return on capital. This is the operating income I just talked about, after tax of income divided by your total book value of capital. This is the return, how much money you return from your investment. You use the return on capital multiplied by the reinvestment rate. That's your estimated revenue growth for the future. But after I bought the company, I realized that for many companies, their return on capital is not consistent, right? Like for example, the company they can when they just founded, they probably don't return any capital. When you just found the company, you spend many money it. Just like when you just have the company start, you need to pay for the property, you need to buy the chef, you need to buy so many things, but your customer haven't come yet. So usually young company they will start with losing money, and then as they grow, they will have return. And as the company grows, the return can be higher. So how do you explain the future growth when the growth rate are not stable? So I come up with something I call efficient growth. Efficient growth is just like say in the past you have 20% return rate on investment, but then next year you have 30%. So last year you have 20%, this year you have 30%. This year in fact you are more efficient than the last year. So I use 30 divided by 20% minus 1. That's what I call the growth rate of growth rate. This is what I do. Like for example, I use the 93% divided by 34%. This is like how efficient the company grows in 2021 compared to 2020. And I got a median. So if I want to know future growth rate, I can use, for example, this 30% multiply 1 plus 35. And next year, 30% multiply 1 plus 35 and another 1 plus 35. But you need to be very careful. Usually, the company can only have efficient growth for 2 or 3 years, depends on its business model. It cannot efficient growth forever. So over time, you need to decrease the growth rate after a while. This is how I estimate the growth rate in my first valuation. Here, you can also see the picture. You can see the share of CPU is used to dominate by Intel, but the AMD has been catching up. So when I do this internal growth, I post my first my AMD valuation. And as you can see, in March 2024, last year, I used such a method to value AMD, and I post the value per share, the price I plan to buy AMD in this post. You can tell that in 2024, I estimate the AMD value at around $182 per share. And I also talk about what if the China ban the AMD stocks. I estimate that if the US enforce the semiconductor ban, the interest value is about 150. This is my valuation in my last time. But after I did the valuation and I did buy the stock at around 180 and 150, I found that I made a mistakes. The mistake is a company cannot grow forever. It cannot grow bigger than the total market. What I try to say is like, although the AMD, I give it very high growth rate, the total revenues cannot larger than the total semiconductors industry market size. To take an example, just think about you are a company in a country, and the country have 100 billions GDP. Your company is a large corporation in the company, they have 10 billion revenues. You can have high growth, but it's very unlikely that your revenues will over $100 billion, right? Because the total country GDP is $100 billion. If you one company have $100 billion, what about other business? So it's important to think about the market, total market for the company. And here you can see that we have market share for AMD. Uh, Intel used to be dominant, with the AMD has been keep growing. So what I do is I just uh, see the current market size for each business segment for AMD. We have gaming, data center, CPU, APU, embedded processor, how much total market it is, and how much market share the AMD have. And I also check information about those business sector market size after 10 years. If you have been watching my video, you know that I rather use the analyst consensus, because if you use analyst data, that's not your valuation, that others, right? But in this case, I do use the analyst consensus, because when you talk about the microeconomic information, the GPT, the overall business, that is kind of more accurate than the single business consensus. And also when you buy stocks, you are not trying to beating for the truth, beating for what really happened. You are buying stocks based on other players like investment banks, mutual funds. If you can make a better estimation than others, then you can make the money. So here I just use analyst consensus for the how much the market share will be in 2034 after 10 years. And here I will give you caution that for AMD, its data center include both CPU and GPU, while Nvidia mainly produce GPU, which means that in the data center business, I add both the data center CPU and GPU to the AMD. If you recall, when I just valued the company, I say that AMD have 30%, about 30% the market share in the data center. That just didn't consider the CPU as well. After I consider the CPU, you can tell that right now AMD have around 10% market share in the data center business, and we also have the CPU, the APU, etc. So this is what I estimate for the AMD market share growth in the future. Like for example, here we have data center around 500 billion total market, and I expect AMD have 10% market share. So what you do is in the year 10, we have this amount of total market AI market multiplied by the estimated AMD market share, you get how much revenues AMD will have in 10 years. And you have the revenues right now, right? I will use this number, subtract this number, and divide by 10. So next year I just add tens, add tens, add tens, add tens. So the good thing about doing that is I will reduce money noise. Many people buy stock data. How do you know? Cannot be wrong. How do you know next year revenues? I cannot know. No one can guarantee. But just think about if I ask you how much revenues a pizza restaurant can make. If I ask you how much the revenue can make 10 years, your estimate will be easier than how much you estimate for next year, right? Because for the 10 years, some years are higher, some years are lower, their effects can cancel out. If I ask you how much you make next year or even next month, the estimation will be much harder. So by doing so, I just smooth out the noise, smooth out the volatility. So this is what I do. But the next question is, how do I know if it's 10%? How do I know if it's 30%? I don't need to get a specific stock price. I can use distribution. So as you can see here, I just show different scenario. Like here we have, what if the AMD have 10% AI market share next year, or 20%, or 30%? And after that, another thing I do is like I maintain the 10% for AI shares. And what if the AMD have 20% CPU, or 30%, or 30%? I do all of them. I didn't cover all of them in their PowerPoint, but I have a nice scenario. And after I do all of them, the value per share that I estimate for AMD is around median is about 122. And next we will talk about the tariff and the China effect. In my valuation in the March, I just expect the AMD to lose all of its revenues from China in the future. From the company's reporting, I saw that AMD have around 24% revenue from China, but I don't expect it to lose all of them in the current year. So what I do is I expect that the company will lose Chinese market in 5 years. So I just divided this 24% by 5. So we get around 5%, and next year I add another fifth, another fifth, another fifth, another fifth. I gradually reduce the revenue by 24%. But you can also tell that after that, I gradually added it back. Why? Because the company can also make money from other places, right? Like India, like Middle East. So by doing so, I kind of incorporate the China effects. And here, I found that if I consider the China effect, the company value can go as low as 107. And after that, the Trump administration announced that they require AMD to contribute 50% of their revenue from China to the government. So then the work become easier, right? I use 24% divided by 2, and I expect they need to pay that for 5 years. And after that, it also gradually decrease to zero. And after I do all of them, I estimate that the AMD value per share is about $105 and $106.08. And after that, I just learned from news that U.S. government is going to be at stake in the Intel. They want to support AMD to design its own chips. So this is what I do. I know that Intel is the competitor for AMD in CPU. And in here, I have the 50% scenario. After the news, I just remove the 50% scenario. I say, what if the AMD only can have 20 to 30% in CPU, considering that the US government supports Intel? After I do that, the median is about 104. It doesn't change that much. This is what I estimate AMD at this moment. If you remember, I used to buy AMD around 180 and 150. After I do the valuation, I sell part of my shares at around 170. Although you can see that I made 20% from some of sale, but I also have some sale that have no gain, no loss, right? Why? Because I want to reduce the risk. I have a rule that I do not allow any of my stock have over 5% of my holding. The reason is I can be wrong. I remember that last years many people see that Warren Buffett sell Apple stock before the stock increase, and people use that as an example that even Warren Buffett can be wrong. I believe that one of the reasons Warren Buffett sell Apple is not because they think the stock is overvalued. It's because the Berkshire Hathaway have over 30% of their total portfolio in Apple. When you have 30% in one stock, you have a very high concentration risk. If you have 30% holding in one stock, if that stock decreased by 30%, then your total portfolio will lose 9%. You probably have all other companies in your portfolio make money, but you still end up losing money. So that's why I also decreased my holdings. And what the good thing about stock is I don't have to buy and sell all at once, right? I can buy and sell multiple times. If the stock go even lower, I can buy again. So many people like to see that I'm long term. I buy a stock and hold forever and I don't buy. I don't think that is real long-term investing. Right? Long-term investing means your investment is not affected by the short-term news or short-term market momentum. It does not necessarily mean you buy a stock and never sell. I'm okay with buy a stock, and if the stock reach my price target, I can sell. I sell it even I hold 2 or 3 months and I buy again. So this I do. I kind of reduce my shares, and after I reduce my shares, you can tell that my AMD still have about 30% gain rate, and right now the AMD only have lower than 5% of my total holdings. And if the stock goes to 100 in the future, I can buy more. Another thing is about how to sell. If you recall my example at the beginning of the video, I talked about the difference because value and the price, right? The value depends on the company's future cash flow, while the price depends on the momentum. Like those people who sell second-handed football ticket, it's about how other people bid the price. It's also about buying a house, right? Just think about how those real estate agents tell you whether a house is cheap or expensive. They will say, like, for example, if you want to buy a house in the downtown New York, they will compare theirs to other house in the New York or other house in downtown Tokyo, Shanghai, Hong Kong, San Francisco, right? And they said, oh, this house is cheaper than others. The problem with that is it doesn't consider that all house will decrease together. But if you want to decide how to sell, you just need to know what others traders will price the company. And those other traders in the stocks are investment bankers. Investment bankers, they use something called the P/E ratio, price over earning. So this is what they do. They use stock price divided by the company earning per share, and then they compare other companies. For example, if most of the semiconductor company has P ratio of 20 and your company have 15, they will say this company is cheap. But that doesn't consider that coal sector can be overvalued. But they do help me how to sell. If I can know how traders think, I can buy the stock at my own valuation and I can sell based on their valuation to have higher capital gains. So as you can see that at this moment, the AMD P ratio is about 44, while the industry average for the semiconductor is about 25. So I just gradually decrease the P ratio. And how do I know the earning per share? Remember that here I estimate the revenue, I estimate the net income. I use the net income multiplied by 1 plus tax. I know the after tax, I suppress the interest rate, and I divided by total shares. I know the earning per share here. But there's a good thing. Recall that when I value the company, I will consider 10% market share, 20% market share, 30% market share, and I get a median to buy, right? That's just more objective. But if I want to decide when to sell, I can use a higher market share because I'm thinking in the eyes of traders. What traders do is when the price is go high, they try to push the momentum to see it will go higher. When the company is decreasing, they will try to hurt the momentum to see the company will be even worse. So when I decide when to sell, I just use like 20 and 30 market share scenario. So this is all the price. And here you can also see there's something called PV, it's present value. That is a very important concept in the investment. The same amount of money of today worth more than same amount of money in the future. What is that? If I ask you, would you rather I give you $1 million today or $1 million 10 years from now? You will want it today, right? Because today, if you have the money, you can reinvestment to make more money. And also, if I give my money today, you get it right now. But after 10 years, who knows if I will keep my promise or if maybe I go bankrupt and I cannot give that money. So you also have a default risk. So it's important to know how much money in the future worth today. If I sell the stock next year at 194, but that 194 will worth less than 194 today, right? So I use that divided by 1 plus 8%. 8% is just about S&P 500 annual return rate. So by doing so, I ask myself how much money I can make from the AMD if I sell this year compared to just investing at S&P 500. And if you want to know how much they worth in 2028, you need to multiply 1 plus 8% and also the power of 3 because you have 3 years. So after doing all of them, the median price is 227. So I will sell the stocks when it's higher than the 227. But another question is, many times if you sell too early and the stock goes higher, you will regret, right? What should you do? So I don't need to sell all of them, right? So I probably will sell about half of my share when it's close to 300, and another half shares to 400, and another half share 450. What's good is say if I sell half at around 300, if the stock goes down, I still have some money in my pocket. So this is my stock valuation. And if you have any question, welcome to comment under the video and I will answer them. Thank you.